Ladies and gentlemen, a very warm welcome to all of you. My name is Samir Shah, and I'm an M&A partner in Khaitan & Company's corporate M&A group. Welcome to this, our fourth webinar in our M&A Academy program. This program is meant to provide foundational legal knowledge and understanding on M&A transactions and processes in a corporate-style training to corporate executives, in-house legal teams, and other M&A ecosystem participants alike. The participation and feedback we have received on our first three webinars has confirmed to us that all of our efforts in bringing these webinars to our audience have been well worth it. So today, our subject is how to structure buyer due diligence. A significant part of what we do as transactional advisors is to help mitigate the risk. While we wish we could eliminate the risk, but we can't. No one can. This is why perhaps the beginning of dealing with risk and life in general is to know the risk. This process requires investigation, Q&A, discussions, and introspection, all of which put together are called diligence. Whether you purchase your summer couture or an asset portfolio, the entire process of decision making is always supported by diligence. Mostly when parties approach us for a transaction, they have already decided and aligned themselves towards concluding the deal. It is therefore for us to find a way in which parties can conclude the deal, achieve their mutual goals, but at the same time do so mindful of the risks associated with the transaction. And we hope that by the end of this presentation, we will have communicated to you the finer points of what we look to do while conducting due diligence for buyers and what you as a buyer should be aware of while approaching diligence. We will have a formal presentation followed by a Q&A session with audience questions. We've already received several questions through the registration process, and please continue to submit your questions using the webinar portal. As always, if we receive more questions than we are able to address today, we will respond offline over email to all of those questions. We will also send the presentation, the summary notes, and a recording of this webinar to you afterwards and upload the recording on YouTube for wider dissemination. So with this, to introduce our speaker today, we have with us my partner Kapish Mandhyan, who is an M&A partner based in our Mumbai office, although he works on projects nationally. He brings significant deal experience on both inbound and outbound M&A and has therefore the benefit of amassing multi-jurisdictional experience towards M&A due diligence. While we circulated his profile over email to the participants, but just to mention once again, he is an expert and advises clients very frequently on diligence, including having recently advised TPG on its acquisition, on its investment in Fractal, and advising Aditya Birla Fashion in its expansion in Indian designer-driven brands, Sabyasachi and Masaba being the most recent ones. So without further ado, I now invite Kapish to deliver his presentation.
Thank you, Samir. And thank you everyone for joining us today. We can start very briefly with an overview of what the presentation is. We are making a very brief presentation on how to structure a buyer due diligence. To that effect, we split this into three broad categories. Number one, we'll touch upon very briefly on what is the importance of the buyer due diligence. We will then go into considerations that you need to factor in as a buyer counsel or as a buy side into your diligence. These are transaction structure linked considerations, considerations determined by your risk mitigation strategy, as well as your target or sector specific considerations. We will also briefly touch upon other considerations that you need to factor in a general diligence, irrespective of which party you represent. We'll quickly summarize at the end, and as Samir mentioned, we'll open up the presentation to a Q&A at the end. With that, we should start with the first topic as to what is a buyer diligence and what is the importance of a buyer due diligence. As Samir briefly mentioned, a buyer diligence is a legal, financial, and strategic review of the target or the seller. The role of any buyer due diligence is twofold. Number one, it is a reality test, a test of the assumptions of the valuation which you have taken in for the particular target or for the particular transaction. It will evaluate all of the assumptions that you have based, whether it is be on the financial side, the tax side, or even the legal side. The second, and often the most portrayed aspect of any diligence, is identification of risk. Risk identification either in the target or in the transaction structure. As Samir also briefly mentioned, the role of diligence is not to de-risk a transaction. The role of diligence is to firstly identify the transaction risks. You cannot, on a diligence report itself, wish away the risks. So in our mind, diligence and identification of risk is 50% of the battle. The question then that comes in is what happens on identification of a risk. That is part two of a diligence exercise. How do you manage that risk? That risk can be managed as a contract condition, a provision in your transaction documents, most typically as a condition precedent or a condition subsequent or an interim covenant. For those of you who have joined our M&A Academy across the 4 sessions, Ashutosh in the very first M&A Academy session briefly dealt on these aspects. I'll also touch upon what exactly is a CP and a CS. A condition precedent or CP is an event identified in diligence which needs to be rectified before you go ahead and close the transaction. The question that I get asked quite often is, Kapish, how do you identify if a transaction or a DD item is a condition precedent? The simple answer, and the easiest answer would be that it would be basis the risk factor associated. If it's a material or a red flag issue, if there is a bank approval, if there is a counterparty approval, if there is a statutory approval, without which a transaction can't proceed, they are obviously a condition precedent. A flip of that condition precedent is your condition subsequent. Items which are to be taken up post closing the transaction, which are typically in the nature of smaller non-compliances or housekeeping items, ranging from registers missing, failure to update employment records, the policies have slight misalignment with the statutory laws, etc. The difficulty, of course, is items which are not really the red flag and not really small. So that is the art of diligence and identification of risk as to where and how exactly do you structure it. Sometimes if there are key licenses which are missing and you cannot get them as a condition precedent because of the transaction structure or the transaction timelines, we have mitigation strategies coming in where we make a preliminary filing, which is what happened recently. Our target did not have an environmental license, though they were more or less complying with all laws. So we made an application as a condition precedent and getting the condition precedent, getting the approvals for a condition subsequent. Of course, that is also backed by indemnification. The second way of managing or mitigating risks is, and this is my favorite, is price adjustment. If you're a buy side counsel and this presentation is a buy side presentation, so we are more likely paying out the cash here. If in the rare circumstances that there is a diligence item A, B, it is identifiable in absolute INR or USD terms, just deduct it from a purchase consideration, move on. Though these are unicorns in any of our diligence findings, it is very rare that any legal concern has a easy to identify INR amount. Most of these risks are contingent in nature. The third aspect, and the most common, and I'm sure everybody's aware, is on indemnification, on reps and warranties and adjustment of risks and allocation of these risks in the form of a rep and warranty. Now, our next M&A Academy will be focused solely on indemnity and rep warranty. So I'm not going to be picking this up on this presentation, but please join us on the next Academy to learn more on indemnification. So starting with the meat of our presentation, what should you take into consideration as a buyer counsel or as a buyer when you are structuring your diligence, when you're factoring in your diligence? We've put across a few aspects that you need to be mindful of. Number one, on what is the type of transaction that you're doing. If it's an asset purchase acquisition, wherein you're doing very selective asset acquisitions, if you're doing a business transfer where you're picking up only a particular business, your diligence need not go into the larger aspects of the company. You need not factor in other aspects of the business and be very focused only on your particular asset. But in case of share purchase, which is going to be the typical aspect of diligence, which are much more common, you'll have to review the company as a whole. And even if there are small business lines or there are small businesses within the company which don't really add to your valuation significantly, they will also have to be diligent from a legal perspective. The next one is on whether the process that is being run is a bidding process or a bid process or a competitive process, or you have exclusive rights to negotiate with the counterparty. Increasingly in India, because of the way the transaction and the market structure is, we are increasingly seeing bid structures and bid situations or non-transaction documents. And in a bid, you have to be very mindful of the kind of questions that you're asking the target. Repeated questions or questions which are not material in nature tend to offset or upset the counterparty. It makes a bad impression of the buyer, makes it look like the buyer is not serious about the target and is just dragging the diligence process for the sake of the diligence process. So in the bid process, we have to be very, very surgical in our questions, make sure that there are material questions being asked. What we've also realized in practical terms, and we were representing a private equity investor in a transaction where we were doing a bid process. We were coordinating with the FDD team, and we got onto a call with the FDD team, and we told them that we don't have 50% of the contracts, and we are missing so many contracts. And they said that, yeah, we are also missing so many contracts. And it turned out that we had the set of contracts that they didn't, and they had a set of contracts that we didn't. So between the two of us on that call, we shaved off a week of requisitions with the target. So, in a bid process and in general as well, but it's specifically in a bid process, make sure that, all your teams align, everybody has access to each other's data room, make sure that everyone's looking to harmonize your diligence requests so that you have less burden on the target. The third is an obvious point on whether it's a minority or majority, but there is a lot of nuance associated with a share purchase or share acquisition. If you're doing a minority acquisition, your diligence would be very different to what would be if you're doing a majority acquisition. Obviously, you will say, Kapish, that's the most obvious thing on the planet. But I would say that depending on the nature of your acquisition, whether you're a strategic acquirer, even if you're taking a significant minority stake, you'll have other interests in the company. If you're a financial investor, even if you're taking a majority stake, but controls and management still less with the promoters or the counterparties, you'll have other considerations to factor in. So each of these have to be factored into your diligence. While we are on minority stake, our recommendation is always to do diligence of at least some nature. One of our clients came to us a few weeks back. He called me up on a Friday and said, Kapish, we are doing a 1.5% investment primary in a pre-IPO company. The deal is done. You just need to mark up the SSA that's come in, and we are closing on Monday. And we are happy to do that. We are working on the SSA. We turned it around. And while we were not instructed to do so, we just did a customary cleanup check. We ran a public search of the target, and we found like a startling pattern of litigations against a target. And all of them, basis just review of orders on the High Court and Supreme Court websites, we noticed that there were a lot of ED cases and notices associated with the target. Now, this is something that our clients didn't know. And we brought it to their attention, and they were also surprised. So we obviously had to then factor in, get indemnification, work around the whole litigation, get a better understanding of what the risks were. So this is a learning that we took away, that irrespective of the size, you need to do at least some amount of diligence, especially in this day and age where it is so easy to get public information on certain targets. The fourth aspect, and on the right hand side of the screen, these are aspects of the particular transaction, is on how time sensitive the deal is. Do you have to do the diligence in 3 weeks? Do you need to do diligence 6 weeks? Do you need the diligence to be done in 12 weeks? This is obviously linked to whether it's a bid or exclusive process and how long your exclusivity is. And sometimes transactions are time sensitive. It's a fact of life, and we have to work around it. And basis your time sensitivity, you need to factor in your diligence. You cannot expect the entire world or the entire diligence ambit to be crunched into a week. Like, for example, a private equity investor was evaluating a target. more than $1 billion valuation. He called us up. He said, "It's a bid process, Kapish. We are 1 week behind." So we said, "No problem, we'll get on it." So we staffed a significant amount of lawyers. We had 20 lawyers on the data room. It was obviously populated, so we had documents to crunch through. 20 lawyers over 8 days, day and night, and we managed to send one email of red flags to them. You know, that was also a funny thing, is that you can have a quick diligence or you can have a cheap diligence, but you really can't have a quick and cheap diligence. So you have to put in 20 lawyers, you have to put in 20 lawyers and get the time done. That said, you can't really keep crunching this timeline. You can't say, Kapish, Khaitan has 1,000 lawyers, put all of them on this deal and give me a report in an hour. There is a limit to this elasticity available in any such diligence. Another aspect that you need to factor in your structure of diligence is how much access to the target do you have. We don't see this as a concern in Indian diligences, but offshore, where the sellers are different from the target, the sellers don't have control, and the target's an independent company. The target employees or the target has all the information, but they may not be aware of the transaction at all. We recently closed a transaction for our client in Germany, and the target was not at all aware that this transaction is happening. They were given the impression that it was a minority acquisition or a minority investment. So we had to tiptoe around the target, make sure that they were not spooked by our questions. The last and most important aspect in any transaction linked consideration for a diligence is a materiality threshold. A diligence is a balance of risk, time, and costs. You as a buyer, and most of you are in-house legal officers within the company, and this frankly is your most important role in any transaction or any diligence, is to identify the materiality threshold. You can obviously discuss this with your counsels, but you need to understand as to what is important for the target and what is the threshold, how much diligence that you need to do. And this materiality carve out or materiality threshold needs to be factored in from a transaction point of view. Moving on to our next set of aspects. As you mentioned, we have broken up the structure into 3 points or on how to structure the diligence. Point 1 was obviously transaction linked aspects. Point 2 is on risk mitigation linked aspects. A diligence is not, as I mentioned, a de-risking exercise. It's an exercise on identification of risk, and the counter to that is 50% is identification of risk, and then 50% is mitigation. How do you mitigate? Therefore, impacts how do you do the diligence. For example, if a W&I insurance being sought in a transaction. For those of you who are not aware, a W&I insurance is basically a warranty insurance. A breach of warranty is a risk, and like any risk, you can go and get an insurance for it, wherein the insurer will step in. Of course, there are lots more complications and permutations, combinations, but very broadly, an insurer will step in and will, instead of going under the indemnity, you have an insurance policy, and the buyer has a recourse against the insurance policy rather than the seller. Now, in such a situation, if you are doing a W&I deal, you will have to quite conversely do more diligence than you would do in a normal transaction. Because not only do you have to satisfy yourself internally within your team and within your advisors that you have done appropriate diligence, an insurer will step in and will look at all the DD reports that you have created, all the documents that you have requested for, and all the review process that you have conducted. And if the insurer is not happy, he will redo the process. So to save time in a W&I linked deal, we have a lower materiality threshold. In fact, we do more diligence, we cover more aspects in order to not reopen the entire diligence process. We did a deal for a client once, acquisition of a significant minority interest in India, has 30 subsidiaries abroad, out of which only 4 or 5 were material. We had reviewed those, and the deal then flipped into a W&I structure. And we had a really tough time convincing the insurer to give us coverage for the 27 odd subsidiaries without any amount of diligence. So whenever you're doing a W&I linked deal, make sure that the materiality threshold is lower than market, because that will help you get the W&I insurance policy faster. And especially last year, insurers were the gods there, and they were just doling out whatever they want. So it was definitely an insurer favor market last year. This year there's some return to normalcy, but last year they were definitely very strict on this. The next aspect is, if you're doing a distress asset, if you're doing a process under the IBC wherein the RP is in charge, and you are acquiring an asset on which is on distressed and under the control of the lenders under the COC, diligence is very, very different. You really don't have any indemnity because the creditors are running the process. You don't really have recourse against them post the acquisition. Thankfully, you have statutory protections and you have statutory protections against liability under the IBC code. But that itself is not sufficient. There might be concerns coming in later. There might be a pain factor on additional litigation. So you have to factor in those upfront. This is doubly difficult because these processes are typically competitive, so you can't really knock off all costs upfront. But there is a tightrope walking that you do need to do in the distressed asset acquisition, and your diligence has to be factored in accordingly. Also, in an RP-led diligence process, the RP may not have all the information as well. So there's a lot of blind spots and open areas which you'll have to factor into your transaction and your diligence structure. The next is on the lockbox structure. A lockbox, for those who are not aware, is a construct within the SPA wherein you identify a date on which the economic interests of the target move to you. That is different from closing. A lockbox, like right now we're doing a deal, the lockbox is 31st December 2021, whereas the deal will close somewhere in August or September. Typically such large, long lock stop dates are not common. It is for this particular deal, and depending on how long this lockbox date is different from your closing, or what is the time period there, you may want to consider, especially on the financial side, a top-up diligence to see if everything is in line, or we'll have to build in additional protections in the transaction documents. So for example, the transaction that I was referring to, with an extensively long time period between lockbox signing and closing, we have a significant interim covenants on the counterparty, and we've really they need a permission for almost every transaction. Moving on to our third limb of what is basically a target specific consideration. Now every target has every diligence is bespoke, and every diligence need to be done in a specific manner. You can't really have a cookie cutter diligence for every transaction. You can't pick up the phone and say, hey Kapish, you did transaction A, let's repeat the diligence completely. Of course there's a vast amount of overlap, but you have to be specific on every target. You have to review the IM, the management presentation, identify what the business of the target is. Only once you know the business of the target, you discuss it with your deal team, will you know what exactly is the company that you're diligencing. One of our clients came to us for a edtech target, and we looked at the IM and says, hey, it's a great edtech asset, but they have an entire platform business inside, which we need to diligence in a different manner. And we needed to actually factor in two parallel diligence processes, one for the edtech business and one for the platform business, and that was run separately. In any business and any area, we've been around for 110 years. We've done a few transactions. Every industry has its own quirks, has its own issues. Discuss this with your legal counsel. Your legal counsel will know of problem areas or watch out areas on every transaction structure. So if, for example, you come to me and say, hey, I'm looking at an ITES asset, my first question is, are there SEZ units in that asset? Have SEZ approvals been taken for previous transactions? You'll have to take an SEZ approval for this transaction. Most people don't. Soft text filings are done or not. If there is a complicated internal structure wherein a lot of offshore subsidiaries are created, RBI is clamping down on delayed payments from subsidiaries to parent companies, whether foreign receivables is received within time, whether it is meeting the SEZ requirements. If you come to me with a multi-brand asset, my first question would be, is there a non-resident investor? Is it FEMA compliant? If it has an e-commerce wing, whether they are doing marketplace, are they complying with the FDI norms and also historic FDI norms, even pre the relaxations. If you come to me with a fashion asset or a retail asset, the question would be on IPR, whether they own the rights to the brand, which is their bread and butter, whether their leases are in compliance, all of their stores, do they have sufficient leases? Do they have a competitor as a landlord? These are some of the questions that you can ask. In AI, new age technologies, the biggest concern we are seeing is on data breach and on ransomware attacks. Like 3 out of 5 deals that we are doing in this space has a ransomware attack on it. Most targets typically take insurance, but even after insurance, there's requirements to notify the government authorities in India. Most people don't do it. We have to also be mindful of GDPR and data privacy breaches, and a significant liability in contractual terms with the counterpart. And also on where exactly your target is, basis that you need to factor in your particular jurisdiction. Like Samir mentioned, we've had the opportunity and the privilege of doing a few offshore transactions. An acquisition in Germany is very different to one in India. Germany, while has a voluntary FDI approval, it's more or less mandatory for any large acquisitions. So you need to be mindful of the local laws there as well. And that can be done. You can speak to the legal advisors in India, who can in turn speak to their foreign counterparts, or you can speak to them as well and factor these in as a watch out area even before you start the diligence. I'll very briefly talk about general considerations for any diligence. A is confidentiality. You need to keep everything confidential. That goes without saying. But especially on public limited public M&As, on the buy side and the sell side, you have to keep in mind UPSI. The fact that you're acquiring as a listed company an offshore entity or another entity is UPSI. So you have to make very careful analysis of whether any unpublished price sensitive information is being sent to anybody. We have clean teams, like separate teams with limited confidential information which is uploaded, especially for strategic acquisitions, where only the legal team has access to it, and where all the information is unredacted but can't be shared with the business teams. So those are aspects that you have to factor in from a confidentiality perspective. Technology is another rising impact. I think from a diligence perspective, tech is the cutting edge in the Indian legal or even the legal technology field. You have beautiful data rooms now, everything is virtual, IP linked, protection there. You have AI products coming in, and we've implemented rudimentary AI tools already. You have public searches, in India, growing increasingly useful. As I mentioned in the past, litigation searches are becoming great. So those are something that you need to factor in and try, and we obviously will, and if you guys can as well, implement technology into the diligence process to make it efficient. Number 3 is on management Q&A. It's a tool that we sometimes overlook in diligence, especially in India. I at least make it a point on most transactions after a week or two of diligence to request for a management Q&A, get answers to questions which have not been really understood in our rec list. There is some time lag there. They're not able to understand our requisitions, and sometimes having a discussion with the CEO or the CFO or the CTO really helps answer some questions which are plaguing us. Obviously, we can't rely on the conversation alone, but it really helps steer the diligence. Of course, this is linked to our original point about whether you have access to the management at all. The last point is on prioritization. Time is valuable, time is scarce. You need to identify what is important. We had a target where there was one person responding to legal, financial, and tax comments. So we had to talk to our financial FDD guys, say, hey, you guys need computer verification of your assumptions. Okay, you guys go ahead first. We will come back later. Even in our diligence, we need to do contracts first because that's critical. Share registers were a little lower down the line, and employment registers, for example, were last on our list. So prioritize. Hopefully you don't need to do it too much, but prioritize and make sure that all of your advisors are in line. You have to go get in diligence somewhere between a hasty once over and an overkill. And there's nothing like a complete diligence. You cannot do a complete diligence. You have to stop at some point, and that point sometimes is when the counterparty is upset with you. To briefly sum it up, one, Diligence is super critical. Please do not skip it. As little as possible, whatever time you have, try and do some amount of diligence. It'll go a long way. Number two, there is no cookie cutter diligence structure. You need to make sure that there's nuance to your particular transaction. A stitch in time saves nine. Having a conversation upfront, having a structured diligence improves deal efficiency and helps you identify risks faster. The diligence is not in isolation. It needs to reflect the deal realities of timings as well as your risk mitigation strategies. And you need to continuously work with your legal advisors to make sure everything is aligned. It's not a one and done. It needs to be continuously factored in. We hope that during the course of this presentation, we could highlight some learnings that would ensure that your next diligence is focused on key areas and optimally utilizes resources available to you. We hope that this will help you identify any risks in a transaction and help you with the mitigation process. Thank you once again for your patience on this. And with this, I hand this back to Samir, who will open up the floor to the question and answers.
Thank you very much, Kapish. And I've been just keeping track of all the questions. And I must say, why don't you grab your breath while I figure a couple of questions that I should throw at you. But wow, that's a lot of questions. Okay, let's start with something we got in registration.
Sure.
So what do you see, Kapish, is the role of a company secretary in facilitating an M&A transaction due diligence? And again, both in-house as well as a practicing company secretary.
Yeah, Samir, I think a company secretary plays a really important role. Especially in listed companies who are most of our clients have a very big company secretarial team. They're a great asset to have. You can definitely leverage them to do a review of the secretarial compliances, to do a review of the internal documentation that's happening, to make sure that the targets level of secretarial compliances are in line with the in-house requirements or expectations. So definitely, we while the lawyers will review the corporate secretary aspects as well, we always like to have a once over by the company secretary as well to make sure the minor nuances, the time of notice, and all the other secretarial compliances associated with it are covered aspect.
Interesting. Okay. One other question back from our registration was we see sometimes buyers dispensing with due diligence, and there was some reference to something ongoing, largely internationally. The question they're saying is, what if a buyer waives due diligence and discovers a dent in the company later? How should a buyer deal with it, and can a buyer at all waive due diligence?
Yeah, it's definitely possible to waive diligence, and we have done deals without diligences. Depending on the structure of the deal, either it's an as-is whereas basis, so you don't have any recourse. That's a commercial call. Typically, you'll have reps and warranties and indemnity protections in the transaction documents. But in my personal opinion, it's suboptimal to try and find out a problem after you've invested in the company and then fight with the counterparty and get indemnity. Indemnity is a fight, it's a dispute, it's a litigation. It's not that straightforward. If, for example, you knew about it beforehand, you could factor it into your transaction docs, you could factor into your purchase consideration, or even agree that this is a risk that you will get indemnified for. So while it is possible to do a transaction without diligence, I wouldn't recommend it.
So, okay, so now here's an interesting one. You mentioned it's important to identify the risks and raise those with the seller, have a conversation early. How do you convince the sell side to help mitigate the risks?
The simplest way, you tell them that sir, if you don't mitigate this risk, I will put it as an indemnity, and then it's at your cost. And that typically is the stick approach that I use, and they get on board very quickly. And see, once a diligence is complete, once a transaction is progressed, everybody's on the same boat. It's in everybody's interest to get the company in order. We've deputed lawyers to the counterparty, and said that, okay, we'll work with you. Your registers are not updated. We have sent people over and worked with them and updated the register with them. So it's everybody's on the same boat. You have to convince them that first of all, it's your company. I've not even acquired it right now. You are definitely in non-compliance. I have given you a free gift of telling you that you're in non-compliance. Please fix. I'm telling you the way to fix it also. And if you want, our lawyers will help you. And it helps you. It helps me. Everybody. It's just it benefits everyone. So I think that's the way to pitch it to the sell side to help mitigate the risks.
Okay, interesting. There are a couple of questions around costs because you mentioned the entire cost benefit analysis of the due diligence. I'll try and bundle both of them together. So one question is, how do you balance and control costs in small targets diligence? And then the second sort of connected question is, will it be common for a buyer or an investor to recover diligence costs from the seller or the company?
Yeah, so for costs on every diligence, my clients think I overcharge them, and my managing partner thinks I'm too kind to my clients. So cost is always a factor that you need to keep in mind in any diligence. The way to handle costs is identify what's really important. If you're looking at a small target, if you're looking at a tight budget, do you really need to look at all the employee registers? Do you really need to look at the non-essential parts? If you're doing a minority acquisition, look at your shares, look at the title of shares, look at key litigations, look at material contracts. If there's a contract with 75% of revenue, just review that. So, depending on that, just crunch your diligence to absolutely necessary, or crunch your diligence to key aspects of the diligence, and that is the way to do it.
Hmm. And recovery of costs by the buyer from the company or the seller?
Purely commercial, we typically see that some investors manage to put in provisions in the term sheet itself for recuperation of some costs, but the costs are typically capped and typically don't really cover the entire diligence expense. So it's not your only recourse. You will be able, it'll help you down the road, but it won't meet all of your costs associated.
Understood. Okay. There are two or three different questions on public records because you mentioned that you can obviously leverage a lot of publicly available information to conclude your diligence. So one is, if there's a private company, can you conduct diligence only basis publicly available information? There's a second question around what are the examples of publicly available information that you can use? And the third is, that's a technical question. Is publicly available information presumed to be to your knowledge even if you ignore it?
Okay, so three aspects. Point number one, whether private company public diligence only on a private company is sufficient. I wouldn't say so, because I'm just answering the second question as well. The recourses available to you is your ROC information, which is including your previous audited accounts, your MGT 14s, your SS7s, your share structure. But these are all dated. They'll be as of last year or post facto. Second, you mitigation. We have few brilliant partners who have like an AI tech kind of setup wherein they will comb through some 30,000 websites that are there all across and get you a report that says, oh, these are the litigations that have been filed. Fairly accurate, but they don't give you details, but fairly accurate. So you identify something. And of course, real estate is land. So you have that available. Go down to the local sub-registrar and get information. That typically we see on asset acquisitions or where real estate is a key component of the transaction. But in private limited company, I don't think that's enough to just do that. Like the example I gave you of the pre-IPO round here, we managed to like say, oh, there's a massive red flag, this is available, but I wouldn't say that that's enough diligence to go ahead and do the transaction.
Excellent. And apart from real estate, do you see publicly available information being presumed to be our knowledge?
No, we don't put it in. And also in your SPA, you will have a provision in. You would definitely need to have a provision that the only information that is disclosed is your disclosure letter. You have those provisions built in, and those are held up in court as well. So yeah, unless you definitely need to have that provision, I'll be very surprised if it's not. But if this information isn't available, then yeah, publicly disclosed information can cut against you. So that's why in most SPAs we have a provision in that no information other than disclosure or data room, depending on where you are on what you've negotiated, is cut against you in the reps and quantities.
So that's a good segue into my next question, because there's a question on disclosure and why should or why should not a data room be treated as a disclosure?
So this is a buy-side presentation, so data room disclosure is not acceptable. But that was on a lighter note. But see, we are increasingly seeing data room disclosures being accepted. Let's put it this way. On a UK deal or a US deal or a German deal, it's a give. It's not even a negotiation. A data room is disclosed.
Yeah.
In India, we still have the disclosure letter construct, but we are increasingly seeing a data room disclosure. Now, if you do a WNI, your data room is already disclosed. So for WNI deal, so we don't even negotiate that. It's already disclosed. It's already going to be carved out in WNI. So in some deals, we have taken data room disclosures. Again, in India, everything is on the table. Everything can be negotiated. So I wouldn't say it's market to accept data room, but it is increasingly going towards that way. So the past 5 years, I've seen more data room disclosures than I saw it the 5 years previous to that.
Understood. Just moving from private to public companies a little bit, and there's a question on any specific items to be borne in mind while diligencing public limited companies, and that too, say maybe beyond public limited, say publicly listed companies. How would that differ from a private company?
So for public limited companies, thankfully, you have a lot of more information in the public domain. You will have, quarterly reports uploaded. The quarterly reports, you could have some amount of reliance on them. It's while they're not audited as such, but it's very unlikely that a listed co will make a huge blunder on your quarterly returns or quarterly disclosures. You have SEBI disclosure requirements, so most material information is already in the public domain. So your disclosure is going to be, your data diligence is going to be very limited to non-public information. When you're doing the diligence, you have to be mindful also of UPSI, unpublished price sensitive information. You can't really have access to it and then do the transaction. It needs to be disclosed. You need to have that window of either you do a waiting period until that information naturally comes into the public domain, or you disclose that information prior to the transaction closing or transaction signing. So those are the factors. Especially, I think broadly, A, your diligence is much more limited, and B, you have to factor in UPSI.
Brilliant. Okay, that's an interesting question. Whether a blanket indemnity, I don't know what that would mean, but nonetheless, whether a blanket indemnity is a good substitute to a full-blown due diligence.
So I think the question means uncapped. You have that blank check. So good question. I wouldn't say so. See, I would rather have a diligence, know what the target is, know what the company is doing, know what the risks are, and have a capped indemnity. Because then I know, and I'm entering the transaction with open eyes. So tomorrow, if something does come up, that uncapped liability or uncapped indemnity is only as good as the target, right? And if there is a target killing or a litigation or bankruptcy risk, then that indemnity itself is infructuous. Another thing is also on timelines to getting it done. Now that we have arbitration, things are moving quickly, but you're still looking at a significant lag time between making the indemnity claim and getting the indemnity amount. It's always a struggle. We represented a few clients, and it's a struggle. I have a blanket statement saying that I will pay within 10 days this amount if this does not happen. And I have that document with me, and my litigation team is really happy. They're like, "Oh, Kavish, you got this brilliant. It's a slam dunk. It'll take 24 months." So if slam dunk takes 24 months, there's time lag is a concern.
Okay. Right. Now, in terms of a bid process, and there are a couple of questions on the buy side. There are, in fact, a couple of questions even on the sell side. And I know we're talking about a buy side presentation here. But let's say you're advising a sell side on a bid process. How would you recommend information flow be structured to bidders? What's the suggestion?
So, sell side mandates depends. There are two ways of doing it. One is that you give the same set of information to everyone, and you be fair and make sure everyone. Or the second, and this is the one I prefer, only give information that's asked for. So you basically have a minimum set of docs which are available to all bidders, and then as and when the bidders ask for docs, you sort of give them more access to it. The As a sell side bid process, running process, you need to try and reduce the amount of acquisitions, right? So as much as possible, give the information upfront. Either do it in the data room, or do have a clean team, have a redacted copies uploaded with your amounts deducted, and then do phase two where the reduction is removed. But upfront, give as much information as possible to make the bid run smoothly.
Interesting. And if you're on the bidder side, how do you do a smart due diligence? How do you sort of let the seller be comfortable, keep them warm that you're not over diligencing this, but still get the relevant information that you need.
So for a buy side bidder diligence, you focus on what's really important. We get a lot of cookie points with the sell side by being very smart on our diligence requests. We leverage public information as much as possible.
Hmm.
We don't ask for small issues. Litigation below 50 lakhs, we don't ask if it's a big deal, right? If it's a bid process, I'm assuming it's a $1 billion deal, then you don't really look at 50 lakh litigation. You skip it out. You make sure that you ask material contracts. You ask the what is actually material. If there is 75% or 80% is the top 10 customers, you only ask for top 10. I'm not even asked for top 20 ones. I just said, give me top 10. They are 75% of revenue. It's good enough for us to diligence and get a significant minority. We're very comfortable, have higher materiality thresholds, but keep them in aspects which are really going to impact you. Don't go after share registers, don't go after registers of directors. We don't even go into corporate secretarial compliances. We say, hey, I'm being aggressive here. I'm accepting a lot of corporate secretarial risks because anyway they'll be below your de minimis. So you actually take a de minimis status. What's my 0.1% of the deal value? Don't ask a question below that because that's anyway going to fall under de minimis and get excluded from your transaction docs. But again, this is an aggressive view to take. And if it's a bid, we tend to be more aggressive.
Understood. Okay, just in terms of structuring due diligence, what's an ideal look back period for the diligence exercise?
It's standard. It's typically 3 years, but again, depends on the target. If the target gives you some amount of comfort, if there's a VDR which is there, or if there is a good diligence that has happened, your look back period can be short, can be reduced. Like I once opened a data room to find a Ketan DD report uploaded to the data room. So I had a lot of comfort saying that, oh, up to this date, good. I will only diligence after this date.
Excellent. So there's a question on a vendor due diligence, but before that, I have a follow-up question. So you say 3 years. Would there be things for which you may want to go beyond 3 years? I mean, is that something you would already know, or is that a work in progress as the deal progresses?
So you only go beyond if there's a red flag. So typically we look at the audited accounts, etc. For share title, you have to go back to day zero, right? But
Yeah.
again, depends on how comfortable you are. If there's a recent dematting that's happened, I sometimes don't. We had a look back period, very small target. It had a 20-year existence. And we had to do a 20-year look back, and
Right.
we drew there were a few misses here or there. Obviously, there will be. There's just too many compliances on FCGPR and ESOP. So we just said, okay, let's do demat. Let's make sure everybody has title now, and that's the way to sort of mitigate those risks and move on. Typically, share issuances, you go back to the day zero, but more or less it's 3 years. It's a standard review period.
Okay. You mentioned the vendor due diligence. But what are the key considerations that you would expect? So suppose as a buyer, you're receiving a vendor due diligence report. What is it that you would want for there to be in that report already?
They should not be cute. So the VDR should, when this is the thumb rule I follow when I'm doing VDRs is don't assume that the other guy is silly or is not got a law firm to look at it. Cover everything, and if there's something you're not covering, let's be upfront about it. I once got a VDR which on page 72 made us reference, not even in the appendix, saying that, hey, we have not covered these kind of contracts, which is critical to the business. So I called up my client. I said, hey, this VDR doesn't work for us. We need to do it again. So that completely defeats the purpose of the VDR. So if you're doing a VDR or if you're getting a VDR done, be honest, be upfront, flag all issues. Everybody will assume we are going to be sugarcoating things, but you can't really avoid or skip things. And the counterparty is going to ask for questions, is going to ask top up. And the objective of the VDR is to reduce that question outcome.
Excellent. And you keep talking about contracts. There are a bunch of different questions on material contracts. I'm going to pick the one that I really like. So this question says, you don't know the business before you step in. Sometimes the target tells you to decide materiality. How do you then decide materiality? That's a very interesting question.
Yeah, that's a great question. So if you don't know the business, you never know the business, right? So the step one is one of our slides covered it is you look at this presentation that has been come to you, the pitch that's come to you. You have a call with the counterparty. and say, hey, what is your business? Talk us through it, understand what the business is and help us explain, understand it. If that's not possible, the way we normally do is revenue based, revenue or profitability based. You ask them for a list of top 25, top 30 contracts with revenue, and then you see whether there's a long tail. If there's a long tail, then great. Top 10 customers account for 25%, then that's a problem. If it's top 20 is accounts for like 90, 93%, great. If top two contribute 50, 70%, great. So that really eases your way out. If there's a long tail, then that's a difficult conversation. You then have to ask for a list of customers. You need to factor in whether you really need to go into all of these contracts or not, and you identify a few, assuming if it's a strategic, the business or know the kind of business, who are the prickly customers.
What if some information is disclosed post due diligence? That's another question which has come up. So between diligence and documentation, you suddenly receive new information.
Oh, that happens unfortunately way too often. But the two things, right? Whether internally do you need the DD report, right? If you internally need the DD report for your internal compliances, if you're a list co, you need to obviously have it for your board. Then we update the DD report if it's a material. If it's not material, then we let it go. Alternatively, if you're internally not required to have a DD report or it's not too much of a concern, we analyze the risk. We just plug it straight in the transaction logs. Thumb rule is, we don't like surprises. We recently closed a deal. Disclosure letter had stuff which was surprising. I said, I don't know. I don't want to open this contract. This contract is 3 years old. If you're given in DD, let's put it in the specific indemnity. We knew it wasn't a big concern. Let's put in specific indemnity and let's move on. I am not going to go and reopen my diligence for one contract that's been suddenly disclosed to us.
I'm just conscious of time, so just to be clear, in terms of diligence process, I know your preference, Kapish, but clients, would they prefer a should a seller insist on a physical due diligence or a virtual due diligence? What should a seller do in your recommendation?
In my recommendation, I always prefer or data room. I'll tell you why. Even as a sell side, because in the sell side, if I have a room and I have people in the room, you really don't know what's happening. Everybody has a scanner in their pockets, right? At the end of the day, you really can't control the leaking of information. So the way to do it is to do it as get a good data room provider. Like, please no Google Drives. Please no OneDrive with ability to download. Have a good data room provider. Get restrictions, and please don't do restriction on every document. Be kind to the other counterparty lawyers. Your key contracts or something which is confidential, put IP restrictions on it, put screenshot restrictions on it. You can do that nowadays. You have that tool, and you should, because tomorrow, even if there is a leak, you then have the ability to ask them, hey, there's the IP access. Is what I got in the local Xerox shop. I found a IP watermark with Kapish Mandan, so they know Kapish Mandan's leaked it. So you need to have those protections built in, and that's why I always prefer a virtual data room.
And obviously, if you have a virtual data room, you can at least make the argument for a data room disclosure. I know we're on a buy side at the moment, but on the sell side, a physical data room will be that much more difficult to argue about. There are 2-3 questions on indemnity, and I'll probably try and word it differently to you. Now, if you're buyer counsel, we know we're not litigating, we know we're not adversarial to each other. How would you recommend, what all information do you recommend giving to the seller when you're requesting for a specific indemnity or negotiating a specific indemnity? Is it good to give more or is it good to give less?
That's an interesting question. I like giving more over a call. I don't think we need to like drop them emails, or I am against sharing DD reports with the buy side unless you absolutely need it. Your legal, if you're with us, we'll give you a curtailed list of things that need to be shared with them, or like a CP list or a CS list, etc. etc.
Yeah.
The DD report itself shouldn't be shared unless absolutely critical. On the specific indemnity, depends on what kind of specific indemnity you have, right? So I did a diligence where there was no registrations across three locations.
Wow.
So I had to say all applicable law breaches. And obviously counterparty had questions. He has not done a diligence on the target. I have done it. So I had to explain it to him. I had to take him on the side and say, hey guys, you can't really negotiate this because your company doesn't have any license. So Those are the conversations you need to have. So you have to give enough information to justify your position. So I got that specific indemnity for me, though it was broad, but that was the factual situation.
Okay. I think there's a question which is meant more for Vidushi, but why don't we quickly take it? So it is, if there is a disclosure made by a seller against a rep in a warranty and there is a breach of that rep later on, can the buyer still seek damages against it?
This is a good one. But now I'm stepping onto Vidushi's term, which is she's going to do the indemnities in the next session. But it depends on how you draft a disclosure, right? If you have written, you've been very smart in the way you've drafted a disclosed definition, and this is a negotiating point we did in the last deal. The disclosed needs to be accurate and true and complete, right? The argument, and if you have drafted that disclosed definition correctly and the disclosure letter, you have been smart in your markup and made sure that it is saying that the claim is only so and so, or you've restricted it. Then you take an argument that the disclosure was not complete, and to the extent the disclosure not complete, you have a recourse against the seller. But again, this is only in the case the disclosure is incomplete. If they say, now flip of it is, if they say including a claim of so and so INR amount so and so, then you will not have a claim against them. So you have to be very, very particular on obviously the language of a transaction document, the language of a disclosure letter. But there is, buy side only, okay guys, so nobody talk to the sell side on this. But if you're smart, or if you're there are booby traps which are around this.
Excellent. Can you give examples where you found something in due diligence which has actually led to the deal not happening? I think we'll take this as the last question, but any examples that come to mind?
The IPO example I gave, the pre-IPO round, 1.5%, the deal tanked.
Oh, gotcha. Anything else that comes to mind?
No, it's very rare for legal non-compliances to be deal breakers, right? My previous, they're deal delayers. Like I once had to step in on a asset acquisition and rectify everything that we found as an issue. Like we didn't send the DD report out. We deputed a team of lawyers onto the target site and fixed everything. And that's something that we have done, but it's very rare for a deal breaker to pop up in diligence, but it's not unheard of.
With that, I think we should conclude the Q&A. Thank you, ladies and gentlemen, for all the questions. Sorry, we couldn't address all of them. We tried to bundle as many of them as we could, but thank you once again for your participation. Before concluding, we would like to ask each one of you to respond to a poll. The poll will flash on your screens momentarily. Please provide your feedback on today's webinar. We take this very seriously. You will also separately receive a request for feedback. It takes less than a minute to complete, but it gives us invaluable insight on future activities. We received a lot of feedback on earlier webinars to introduce more examples, more case studies on a no-names basis, and you saw how Kapish has woven into his presentation and his Q&A responses practical examples. So that's a great feedback that we received. So we'll wait for you to finish the poll. So with that, thanks to everyone who participated in the poll. And to summarize some of the key takeaways from today's webinar, like Kapish said, you can never diligence enough, but there's absolutely no joy in over diligencing a target. It's important to strike a good balance to avoid surprises for the future, but to also optimally utilize available resources. It is important to give your advisors a very good understanding of your reasons for wanting to buy, and also a detailed and elaborate understanding of the business behind the target. It helps us ask sharper questions and ensure the diligence carries a razor sharp focus. The diligence is incomplete without reporting and resolution. And if we could say, the proof of the pudding is not in identifying the risk, but it is also in demonstrating the experience around how to tackle that risk and convert that into an opportunity. This is where quality and experienced advisors will come handy. And with that, I finally would like to thank Kapish for such an innovative presentation and peppered with examples, and also to our audience for your attention and your overwhelming participation. We hope you found the webinar interesting and a worthwhile investment of your time. We've obviously certainly enjoyed bringing it to you. Please do not hesitate to contact us should you need any further information. Our contact information is on the slide before you. And thank you once again for your attendance today, and we look forward to your participation in future webinars.
Thank you, everyone.